You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
You probably opened your investment app at some point this week.
Oh, almost certainly. Everyone does.
Right. And, you logged in, you saw that little line chart tracing your net worth, and you likely felt a quiet sense of security.
Yeah, that feeling of doing the responsible thing.
Exactly. Because you followed the golden rule of modern investing. You bypassed the gambling impulse. You didn't, chase random penny stocks or speculate on unproven crypto tokens. You just bought an S&P 500 index fund.
The classic set it and forget it move.
Right. You own a fractional piece of the 500 largest, most dominant companies in the United States. And, according to the conventional wisdom of, the last 3 decades, you are the very picture of diversification.
Mm-hmm. On paper, anyway.
And here's the wake-up call. And honestly, looking at the source material we are dissecting today for this deep dive, it is a stark reality for 2026.
Yeah.
More than 35% of that entire fund's weight is currently sitting in one single sector. Technology.
Yep. Just one sector.
And it gets even more granular than that. Nvidia alone makes up roughly 8% of the entire fund.
Which is just staggering when you really think about it.
It is. That isn't diversification. That's concentration, and it's basically hiding in plain sight behind a label that implies safety.
Yeah, because the label on the tin, it reads broad market index.
Right.
But the reality of those underlying assets has fundamentally shifted. I mean, we are looking at a scenario where a tool that was originally designed to capture the aggregate growth of the entire American economy has, it's essentially morphed.
Morphed into what exactly?
Into a highly concentrated thematic bet on artificial intelligence and mega cap tech.
Wow. Okay, so it's a thematic bet disguised as a broad index.
Exactly. And it's because of the mechanics of market cap weighting, where the largest companies automatically get a larger share of your investment dollar.
Right. So the bigger they get, the more money they absorb.
Yeah, it creates this self-reinforcing momentum algorithm. The bigger a handful of companies get, the more of your money is funneled into them, totally regardless of their underlying valuation.
Okay, let's unpack this mechanism because, realizing your foundational retirement investment is actually resting on, one or two massive pillars rather than a network of 500 distributed supports.
It's unsettling.
It really is. It requires a massive perspective shift.
Yeah.
And to frame the stakes of this deep dive, we need to look at an anchor statistic from the UBS data in our sources.
Oh, the stat. Yeah.
It's completely rewired how I view historical market returns. So since 1926.
Which, just to clarify, spans a full century of market data.
Right, including the Great Depression, World War II, the dot-com bubble, the 2020s. Over all of that time, just 0.3% of all U.S. firms have driven half of all stock market wealth created.
Just 3 out of every 1,000 companies.
3 out of 1,000. When you internalize that math, the entire philosophy of index investing kind of shifts, doesn't it?
What's fascinating here is that, it completely upends the traditional view. The traditional view is that we buy the broad market to capture the average return of American business.
Right.
But the UBS data reveals that the average is actually an illusion.
Wait, an illusion? How so?
Well, the median return of a stock over its lifetime is actually negative.
Are you serious? Negative?
Yeah. The overwhelming majority of companies eventually fail, or they get acquired for parts, or they just, slowly bleed out against inflation.
So all the gains are coming from almost nowhere.
Exactly. All the wealth, that compounding engine that builds generational wealth and funds retirements, it's generated by an incredibly tiny sliver of hyperperformers.
Yeah.
The standard deviations of these outliers pull the entire market average up.
Which means we aren't buying the haystack to get a nice average pile of hay.
No.
We are buying the haystack because it is literally the only mathematically sound way to guarantee we own those 3 needles.
That is the perfect way to put it. Because no individual investor, and frankly no institutional manager with an army of analysts, can reliably predict in advance which 0.3% of companies will drive the next century of return.
Right. Was anyone in 1995 modeling the exact trajectory of an online bookstore called Amazon?
Of course not. It's impossible.
Right. So the only logical response to that inherent future uncertainty is, Radical systemic diversification.
Yes, spreading your bets.
Spreading your bets so widely across the global economy that you are structurally guaranteed to capture the next era's wealth creators wherever they happen to emerge.
And that's really the mission of this deep dive. We are going to execute a structural audit today.
I love that phrase, structural audit.
Yeah, we're going to look under the hood of the standard 2026 portfolio, map the blind spots created by the recent tech run-up, and implement the mechanical framework you need to restore genuine diversification.
Because, I mean, missing out on the next 0.3% of wealth creators is a massive opportunity cost.
It is.
But having the bulk of your capital trapped in yesterday's winners when the market cycle turns, well, that's an existential threat to your portfolio.
It's the difference between underperforming and getting wiped out.
Exactly. So let's look at the sheer scale of the concentration problem right now, which our sources actually dubbed the diversification illusion of 2026.
It's a great term for it.
If we examine the Morningstar U.S. Market Index, the 10 largest constituents now consume 36% of the total index weight.
36% in just 10 companies.
Yeah. And just 5 years ago, that figure was 23%.
Which was already considered high back then.
Right. And the sources note we haven't seen this specific density at the top of the market since 1932.
And that 1932 comparison is critical for understanding market vulnerability.
How so?
Because in the early 1930s, the concentration wasn't in tech, obviously. It was in a handful of massive industrial monopolies and railroads that had somehow survived the initial shock of the 1929 crash.
Ah, okay, so survival bias.
Exactly. When capital gets terrified, or when it falls deeply in love with a singular narrative, it herds. It moves as a massive flock.
And in the 2020s, that herd migrated entirely into the AI trade.
Yes. During that massive build-out between 2023 and 2025, companies tied to the physical layer of artificial intelligence, the chip designers, the foundries, the hyperscalers.
They just absorbed all the oxygen in the room.
They absorbed nearly all the liquidity in the market. The index funds, strictly following their market cap weighting rules, just blindly bought more of whatever was going up.
Which creates a really dangerous psychological trap for the retail investor. I mean, the classic error is confusing the number of accounts you have with the quality of the underlying asset.
Oh, this happens all the time.
Like, I might have a 401k matching program through my employer, a Roth IRA I manage on a brokerage platform, and then maybe a taxable account on a retail trading app.
And that feels great. It feels like 3 separate diversified buckets.
Exactly. But if the core holding in every single one of those accounts is a standard large-cap U.S. index fund, the diversification is a complete mirage.
An illusion.
You just have 3 different doorways opening into the exact same room, standing shoulder to shoulder with the exact same AI mega cap stocks.
And the friction here is that market cap weighting works beautifully on the way up. It feels like a genius strategy.
Sure, because your biggest positions are the ones growing the fastest.
Right. But it acts as an amplifier on the way down. When you own an index that is 35% concentrated in a single theme, you have effectively stripped your portfolio of its shock absorbers.
Wow. Strip the shock absorber.
Yeah. I mean, in a low volatility environment, different sectors appear to trade independently. Tech does its thing. Healthcare does its thing.
Right.
But the historical data on liquidity events shows that during periods of severe market stress, say a sudden regulatory crackdown on data privacy, or a realization that AI capital expenditures aren't producing the expected profit margins.
Which is exactly what people are whispering about right now.
Exactly. When that stress hits, correlations between equities abruptly spike toward 1.0.
Meaning everything moves together. When panic sets in, the institutional algorithms and retail investors basically just sell everything simultaneously to raise cash.
Yep. The fundamental quality of the company completely stops mattering. If it's liquid, it gets sold.
Which is precisely the mechanic we saw in early 2020 and again during the rate shocks of 2022.
Exactly.
But what we are observing right now in 2026 is, well, it's a different kind of rotation.
It is. It's not a panic. It's a shift.
Right. The sources document this massive capital flow that they've dubbed the anything but AI trade.
Yeah, that's the prevailing sentiment right now.
The initial euphoria over AI capabilities has sort of met the sober reality of corporate budgeting. Institutional money is beginning to really worry about the sheer magnitude of capital expenditures required to power these data centers.
The numbers are astronomical.
Right. Consequently, we are seeing liquidity bleed out of the top 10 mega caps and flow down the market cap spectrum into smaller companies, industrial sectors, and value stocks that have frankly been starved of capital for 5 years.
They've been totally ignored.
But, okay, let me push back on this a bit.
Yeah.
Because I see the logic of the rotation, but let me push back on the premise that an investor absolutely must dilute their tech exposure.
Okay, let's hear it.
If we assume the artificial intelligence build-out is a secular, multi-decade shift, right, akin to the electrification of the country or the build-out of the internet, why wouldn't an investor want 35% of their money in the companies building that exact infrastructure? I mean, why deliberately sell the companies with the highest margins and the best balance sheets just for the sake of forced variety?
That is the most common defensive concentration, and it sounds logical, but the risk isn't necessarily that the AI narrative is false.
Yeah.
The risk is that the future growth is already entirely priced into the stock today.
So you're paying for future perfection.
Exactly. When a company is priced for perfection, even exceptional execution can result in a declining stock price if the results are merely great instead of transcendent.
So even if AI changes the world, the stock could still go down because it didn't change the world fast enough.
Precisely. Furthermore, concentration limits your optionality. If you are exclusively holding the top 35% tech bubble of the S&P 500, you are mathematically excluded from capturing the gains of that anything but AI rotation.
Right, because you don't own any of those smaller companies.
You're stuck holding the assets that are experiencing multiple compression while missing the massive upside in the forgotten sectors of the economy that are currently undergoing a valuation expansion.
Okay, so the challenge is restructuring a portfolio to maintain exposure to those secular growth engines, like AI, without allowing them to quietly hijack the entire asset allocation.
That is the exact tightrope we have to walk.
Which brings us to the structural solution highlighted in the research, the core satellite framework.
Such a powerful concept.
It sounds a little overly institutional, maybe, but the mechanics are actually remarkably elegant for a retail investor trying to navigate 2026. The framework essentially bifurcates your capital, assigning two distinct psychological and financial jobs.
Yeah, the architecture is very straightforward. The core represents the overwhelming majority of your capital. Historically, we're talking around 70%.
Okay, 70% core. What's the job of that money?
The mandate for this capital is absolute neutrality and total global coverage. You use low-cost, broadly diversified index funds to buy the entire investable world.
So not just the S&P 500.
No. This means deliberately stepping away from pure U.S. large-cap funds and utilizing total world stock funds that mechanically weight international and domestic equities. This 70% is the ballast. It is the unglamorous, slow compounding engine of your multi-decade wealth.
Okay, and then the remaining 30% forms the satellites.
Exactly.
This is the capital designated for high-conviction, active decisions.
Right.
Like if you have a strong thesis on emerging markets, or a belief in the necessity of a specific clean energy transition.
Or even a deep conviction that artificial intelligence is still underpriced despite the mega cap run-up.
Right. You use a satellite ETF to express that specific view.
And you know, the irony of the framework is that you might actually use an AI-specific fund as a satellite right after we just spent an hour identifying AI concentration as a systemic risk.
Wait, really? That feels contradictory.
It does. But the difference lies entirely in the intention of the sizing.
The sizing. Okay, explain that.
When you hold an S&P 500 fund, the index rules are dictating your 35% tech exposure without your active consent. You're just along for the ride.
Right.
But when you build a neutral global core, your tech exposure naturally drops to reflect the global market average. If you then deploy, say, a 10% satellite specifically into an AI fund, you have reclaimed control.
Because I chose that 10%.
Exactly. You are explicitly defining your risk parameter. If that sector faces a 40% drawdown, the damage is contained to a 10% satellite position, rather than hollowing out the core of your retirement foundation.
It effectively quarantines your biases.
That's a great way to put it.
The behavioral finance aspect of this is fascinating to me. Human beings are inherently narrative-driven creatures. We read white papers on robotics, we see breakthroughs in synthetic biology on the news, and our immediate instinct is to act, to position ourselves for that future.
We want to feel like we're participating in the future.
Exactly. Expecting a retail investor to maintain monk-like discipline and ignore every technological advancement in favor of a sterile, boring global index is basically a recipe for behavioral failure.
They'll inevitably crack and buy a hot stock at the exact wrong time.
Right. But the core satellite framework actually harnesses that urge to tinker. It gives you a sanctioned sandbox for your convictions, preventing you from recklessly betting the farm.
And we can actually model exactly how this structural dampening works mathematically.
Okay, let's do the math.
The sources provide a framework using a baseline $10,000 portfolio. To isolate the effects of asset class variance, let's look at the geometric smoothing that occurs when you abandon a purely U.S.-centric approach.
All right, I'm following.
Consider an allocation of 60% U.S. equities, 30% international developed markets, and 10% emerging markets.
Okay, so mechanically, out of our $10,000, we have $6,000 deployed in the U.S., $3,000 in regions like Europe and Japan, and $1,000 in developing economies like India or Brazil.
Correct. Now, look at a hypothetical year where the return profile is asymmetric. Say the U.S. market delivers a solid 10% yield, adding $600 to your capital.
Nice.
The international developed markets experience sluggish growth, returning only 6%, which generates $180.
Okay, bit of a drag, but fine.
However, emerging markets, maybe driven by a surge in raw material exports or manufacturing, break out with a 12% return, adding $120.
Okay, so we add that all up. The aggregate gain across the portfolio is $900.
Yes. And on a $10,000 base, that translates to a smoothed blended return of exactly 9%.
Now, the immediate counter-argument I hear from the die-hard U.S.-centric investor is, well, I left 1% on the table. If I had just stayed 100% in the S&P 500, I would have made 10% instead of 9%.
And that is the exact trap of sequence of returns blindness.
Sequence of returns.
Yeah, they are looking at a single isolated snapshot in time. The purpose of diversification is not to maximize upside capture in a screaming bull market. The purpose is to alter the geometry of your drawdowns.
The geometry of your drawdowns,
Right.
meaning how deep the valley goes when things drop.
Exactly. Let's model the subsequent year. The U.S. market, exhausted from its run, experiences a multiple contraction and drops 9%.
Ouch.
Meanwhile, the international markets, operating on completely different credit cycles and central bank policies, remain flat at 0%.
Okay, let's look at the U.S.-only portfolio first. The 100% U.S. portfolio takes the full, unmitigated 9% hit, dropping from $11,000 down to roughly $10,010.
Nearly all the previous year's gains are obliterated. You're back to square one.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
But the globally diversified portfolio, because 40% of its capital was shielded in assets that didn't correlate with that U.S. decline,
Right.
it suffers a significantly shallower drawdown, and mathematically, avoiding a 9% loss is vastly more important to long-term compounding than capturing an extra 1% of upside.
Right. Hugely more important. Because the capital required to recover from deep drawdowns grows exponentially. If you lose 50% of your money, you don't need 50% to get back to even. You need 100%.
Which is so hard to achieve.
Exactly. And this mathematical imperative forces us to confront the most glaring vulnerability in the average 2026 portfolio.
Which is?
Geographic concentration. To construct a legitimate 70% core, the portfolio must accurately reflect the investable world.
Okay, so let's break down the actual globe.
The current global market capitalization breaks down to roughly 60% United States and 40% international.
40%. That means almost half of the investable, publicly traded wealth on the planet exists outside the borders of the U.S.
Nearly half. Yet institutional tracking data consistently shows retail U.S. investors holding less than 10% of their equity in international markets.
Wow. Less than 10%.
And there's a massive cohort holding exactly 0. They are purely domestic.
We call this home country bias, right? And it is an incredibly persistent psychological heuristic.
Very persistent. It's human nature.
Yeah, we invest in the supply chains we interact with daily. We buy the parent companies of the software we use, the cars we drive, the retail stores we frequent.
It feels safer because you can see it.
Exactly. Buying a conglomerate based in Switzerland or a semiconductor foundry in Taiwan feels abstract and inherently riskier because it lacks that daily physical proximity. But substituting geographical familiarity for financial safety is a catastrophic analytical error.
It really is. The standard analogy is usually about planting a garden. planting different types of crops to survive a localized drought.
Right, if you only plant one flower and there's a frost, you lose the whole garden.
Yeah, but a much more accurate framework for 2026 is looking at the global economy as an integrated supply chain with structural fault lines.
Fault lines, okay.
If you isolate your capital entirely within the U.S. large cap sector, you are betting entirely on the consumer software, financial services, and intellectual property end of the global machine.
The IP.
Right. But that IP cannot function without the physical layer.
Let's apply that specifically to the AI narrative we were talking about earlier. The general public equates artificial intelligence with Silicon Valley software engineers typing on laptops.
Right, algorithms and code.
But a large language model doesn't just exist in the ether. It requires physical data centers the size of aircraft carriers.
A massive footprint.
It requires immense cooling systems, miles of copper wiring, transformers, gigawatts of electrical generation. It requires semiconductors manufactured with astonishing precision using rare earth metals.
Exactly the point. The physical reality of the AI build-out is heavily reliant on emerging markets. These economies are the backbone of the manufacturing layer, the resource extraction layer, and the logistical layer. They are indirectly capturing massive revenue streams from the AI boom.
Because they're selling the picks and shovels.
Yes. But because they are categorized as emerging markets, their equities do not command the massive valuation premiums of the U.S. tech giants. An investor can acquire exposure to the fundamental growth of the AI industry at a fraction of the price by owning the international companies that are actually building the physical infrastructure.
That is such a good point. I understand the valuation argument, but we have to address the elephant in the room regarding international equities.
The performance history.
Yeah, because for the entirety of the 2010s, international stocks were essentially a drag on a portfolio. Following the 2008 financial crisis, the U.S. entered this unprecedented era of zero interest rate policy, or ZRRP, which disproportionately benefited long-duration U.S. growth stocks.
Money was free.
Exactly. Software ate the world, and the U.S. owned the software. European equities, which are heavily weighted toward traditional banking and legacy industrials, they just consistently lagged.
They look like terrible investments.
Right. So for an investor who spent the last 15 years watching the S&P 500 lap the rest of the world, reallocating 30% of their capital overseas feels like, willingly stepping off a bullet train to ride a bicycle.
That sentiment is the absolute definition of recency bias.
Recency bias.
Yeah, an investor's active memory usually only spans the last market regime. If we expand the timeline and analyze the historical cycles of outperformance, a completely different reality emerges.
Okay, zoom out for me.
The leadership between U.S. and international markets operates in long, multi-year pendulums. From the peak of the dot-com bubble in 2000 through the bottom of the financial crisis, the U.S. market was essentially a lost decade, generating negative real return.
Right, people forget that whole decade.
They really do. During that exact same period, emerging markets and international value stocks experienced a massive secular bull market. The pendulum swung back to the U.S. in the 2010s due to the specific macro conditions you mentioned, but the data from 2025 and 2026 indicates the pendulum is swinging back again.
Because the macro environment has fundamentally shifted. We are no longer in a zero interest rate world where theoretical software profits a decade from now are valued higher than actual cash flows today.
Precisely. And if an investor allows the trauma of the 2010s underperformance to dictate their 2026 allocation, they are fighting the last war.
They're driving looking in the rearview mirror.
Yes. They are abandoning international markets right at the exact moment the valuation spreads suggest massive forward-looking outperformance.
Okay, so let's say we make the leap. We buy the international index funds. There is a secondary layer of friction when moving capital overseas, and it's something the beginner guides almost universally ignore.
Currency risk.
Currency risk. When we deploy capital globally, we are no longer just evaluating corporate earnings and macroeconomic cycles. We are suddenly exposed to the fluid mechanics of the foreign exchange market.
It's a hidden variable that can dramatically alter the realized return of a foreign asset. The mechanics are relatively straightforward, but the implications are profound.
Yak us through it.
Let's say an American investor utilizes a U.S. domiciled index fund to purchase equity in a Japanese automaker.
Okay.
The underlying business operations, the factory wages, the domestic sales, the corporate treasury, all of that is denominated in yen. The stock trades in Tokyo in yen.
Right.
But the index fund must eventually translate that value back into U.S. dollars for the investor's portfolio here in America.
Which introduces two completely independent variables moving simultaneously. Variable A is the actual business execution of the automaker.
Right.
Let's assume they design a brilliant new EV platform, sales surge, and the stock price appreciates by 8% in yen. That is fundamental wealth creation.
Pure equity gain.
Right. But variable B is the macroeconomic relationship between the Bank of Japan and the U.S. Federal Reserve. If, during that same year, the yen weakens against the U.S. dollar by 8%, the mathematics are brutal.
They really are. The currency depreciation perfectly offsets the equity appreciation.
So it's a wash.
Completely. When the fund translates that 8% yen-denominated gain back into a stronger U.S. dollar, the net return to the American investor is literally zero.
Wow.
The underlying business executed perfectly, but the invisible weather system of global forex markets just wiped out the yield.
So conversely, if the U.S. dollar had weakened against the yen, the investor would capture the 8% equity gain plus an additional currency premium.
Exactly. It swings both ways.
But this inherent volatility really terrifies retail investors. It feels like uncompensated risk. The logical assumption is that we should try to neutralize this variable.
It's a very common instinct.
Right. And the financial industry offers these currency-hedged international ETFs, where the fund manager utilizes forward contracts and derivatives to mathematically cancel out the exchange rate fluctuations, isolating just the pure equity return.
It sounds like the prudent choice.
It does. It sounds like buying insurance. Yet, the definitive guidance from our 2026 source material insists that long-term investors should absolutely avoid hedged funds and accept the raw currency risk. Why?
Because the guidance is rooted in the frictional mechanics of institutional hedging. Hedging is not free.
Someone has to pay for those contracts.
Exactly. To maintain a constant currency hedge, the fund manager must perpetually purchase and roll over short-term forward contracts. This requires constant trading, which generates structural transaction costs.
So there's a fee drag.
A significant one. Furthermore, in environments where U.S. interest rates are higher than the foreign country's rates, which has been the case against many developed nations recently, the mechanics of forward pricing dictate that the hedge actually locks in a yield drag.
So you are basically paying an insurance premium every single month, dragging down the net asset value of the fund.
And you are paying that premium to mitigate a risk that, over a multi-decade investing horizon, tends to neutralize itself anyway.
It washes out.
Yes. Currencies operate in relative cycles. The dollar exhibits periods of strength and periods of weakness. Over a 20 or 30-year timeline, the localized currency fluctuations tend to revert to a mean, rendering the long-term impact on the portfolio roughly neutral.
Okay, so it's a wash in the long run.
Therefore, utilizing unhedged, ultra-low-cost international index funds is the mathematically optimal strategy. You absorb the short-term volatility, but you avoid the structural bleed of hedging costs, capturing the purest form of the equity risk premium.
That makes perfect sense. Okay, so we've established the necessity of geographical distribution and navigated the currency mechanics. But the 2026 framework insists that true diversification operates across 5 distinct dimensions.
Yes. Asset class, geography, sector, factor, and time.
We've tackled geography and sector concentration with the tech stuff. The concept of factor diversification is where the analysis moves beyond basic indexing and into the actual financial DNA of the equities we hold.
Factor investing requires looking past just the industry a company operates in and analyzing its actual statistical characteristics.
Like what?
Well, the market has historically rewarded certain types of risk with excess returns. The most prominent dichotomy is between growth and value and between large cap and small cap.
Okay.
The 2010s and early 2020s were defined by the absolute dominance of the large cap growth factor. These are companies with massive market capitalizations and expectations of rapidly accelerating future cash flows.
And if we look at equities through the lens of bond mathematics, growth stocks are essentially long-duration assets.
That's a great analogy.
Because their most significant cash flows are projected far into the future, their current valuations are hypersensitive to the discount rate, which is the prevailing interest rates. When rates were pinned at zero, the present value of those distant future earnings exploded, driving the mega-cap tech rally. But factor diversification demands that we counterbalance those long-duration assets with their exact opposites.
Small cap value.
Right, small cap value.
Small cap value represents the shortest duration equities in the public markets. These are smaller companies, often operating in, unglamorous legacy industries, regional financial institutions, industrial machinery, mid-tier consumer goods.
The boring stuff.
Very boring. And they classified as value because their stock prices are depressed relative to their actual book value, their current earnings, or their free cash flow. They aren't promising exponential growth in a decade. They are generating tangible cash today.
And the data from early 2026 demonstrates exactly why this factor is the ultimate counterbalance to AI concentration.
The numbers are stark.
They really are. While the mega-cap growth stocks were beginning to face multiple compression due to that capex exhaustion we talked about, the small-cap value factor experienced a massive repricing event. It surged 9.7%, while growth managed only 2.6%.
There was a huge rotation.
The higher baseline interest rate environment of 2026 fundamentally penalizes speculative future earnings and rewards immediate cash generation. Adding a dedicated small-cap value ETF to a portfolio introduces an asset that responds to macroeconomic catalysts in a completely different manner than the S&P 500.
It's the perfect shock absorber. And moving to the dimension of asset class diversification, we have to address the resurrection of fixed income.
Bonds are back.
Bonds are back. For the better part of 15 years, the 60-40 portfolio, 60% equities, 40% bonds, was widely declared dead.
Because yields were terrible.
Exactly. When central banks suppress interest rates to the zero bound, the yield on sovereign and high-quality corporate debt was functionally eliminated. Bonds provided a small degree of volatility dampening, but they were essentially dead money, offering negative real returns after accounting for inflation.
But the normalization of the yield curve leading into 2026 has completely altered the architecture of the modern portfolio. Bonds are actually fulfilling their dual mandate again.
Income and protection.
Right. The yields on high-quality U.S. fixed income reached levels not seen in over a decade. In the first quarter of 2026, bonds didn't just act as a shock absorber. They actually generated structural alpha, edging out U.S. equity performance in the early months.
Which shocked a lot of pure equity investors.
We have transitioned back to an environment where investors can generate legitimate, compounding income without taking on equity-level risk. But how much should someone hold?
Well, the implementation of fixed income is heavily dependent on investors' specific liability timeline. If we look at the institutional models, an investor in their accumulation phase, perhaps 35 to 40 years away from drawing down the portfolio, only requires a nominal allocation, roughly 5%.
Just a tiny buffer.
Right. The duration of their timeline allows them to absorb massive equity drawdowns. They have time to recover. However, as the liability date approaches, as you get closer to retirement, the sequence of returns risk becomes the dominant threat.
The risk of crashing right before you need to withdraw.
Exactly. The models mandate aggressively scaling the bond allocation up to 20% or much higher as the investor moves within 20 years of retirement. A 30% equity contraction at age 35 is an opportunity to buy cheap.
Right.
A 30% equity contraction at age 62 is a catastrophe that permanently alters your standard of living.
That makes a ton of sense. And beyond traditional equities and fixed income, the sources highlight a glaring deficiency in retail portfolios regarding alternative assets.
Yes, alternatives are heavily underutilized.
We are talking about allocations to real estate investment trusts or REITs, physical gold, or broad commodities. The institutional research suggests these assets are critical for surviving specific macroeconomic shocks. Yet the data shows only 52% of moderate risk advisory portfolios include any alternatives, and usually in just negligible amounts.
The reluctance to allocate to alternatives stems from a total misunderstanding of their utility.
What do you mean?
You do not hold gold because you expect it to compound at the rate of a technology company. That's not its job.
Right.
You hold a mid-single-digit allocation to gold because it is a non-yielding bearer asset that historically possesses a near-zero or even negative correlation to equities during acute credit crises or sovereign debt panics.
When everything else burns, gold shines.
Exactly. When systemic trust evaporates, gold structurally reprices upward. Similarly, REITs provide an equity-like instrument that derives its cash flow from physical property, offering a natural mechanical hedge against unexpected inflation shocks that decimate traditional bond yields.
They are the ultimate idiosyncratic risk premia. They zig when the rest of the financial system zags.
Exactly.
The final dimension of diversification is time, which introduces the mechanics of dollar cost averaging. And I want to elevate this beyond the basic, invest a little every month definition, because the underlying mathematics actually harvests the volatility of the market.
Yes, it addresses the path dependency of wealth generation.
Explain path dependency.
If an investor deploys a massive lump sum on a single date, their entire financial trajectory is permanently chained to the valuation of the market at that exact millisecond.
That's terrifying.
It is. If the market experiences a 20% correction the following month, that capital is permanently impaired. Time diversification, through automated periodic investments, systematically dismantles this risk.
It effectively weaponizes the market's volatility in the investor's favor. By committing a fixed dollar amount regardless of the index price, the investor is mathematically forced to acquire fewer shares during euphoric, overvalued peaks, and forced to accumulate a significantly higher volume of shares during terrifying, undervalued troughs.
It buys more when it's cheap automatically.
Exactly. It is a mechanical system that completely bypasses the investor's emotional attempt to time the bottom, ensuring that the average cost basis stabilizes over the long run.
Okay, so let's assume an investor processes this entire framework.
They've done it all.
They audit their accounts, they identify the 35% tech concentration, and they execute a total reconstruction. They build the neutral global core. They allocate 30% to high-conviction satellites. They integrate small-cap value, lock in the new bond yields, carve out 5% for alternatives, and automate their monthly contributions.
The perfect 2026 portfolio.
The structure is flawless. But the fatal error is believing the architecture is static.
Ugh. This brings us to the statistical reality check that honestly stunned me. According to a 2026 survey of retail investors, only 30% actively rebalance their portfolios on an annual basis.
That number is wildly low.
A massive 20% admit to literally never rebalancing. They set the initial allocation and let it drift for decades.
And failing to rebalance is the silent killer of diversification. It is a phenomenon known as portfolio drift, and it operates so gradually that it completely evades the investor's risk radar.
How does it work in practice?
Let's model the decay. An investor in 2020 meticulously designs a risk-appropriate 60-40 portfolio. 60% global equities, 40% fixed income.
Perfect.
Then, the subsequent 5 years happen. Equities, driven by the massive multiple expansion in tech, experience explosive compounding. The fixed income portion, dragging through the rate hikes, barely treads water.
Fast forward to 2026. Without the investor executing a single manual trade, the sheer disproportionate compounding of the equities has violently warped the portfolio's DNA. The math dictates that the portfolio is now likely sitting at an 80% equity, 20% bond allocation.
Huge shift in risk.
Massive. The investor still believes they hold a conservative 60-40 structure, but their actual market exposure has mutated. They're carrying a catastrophic level of unrecognized risk. If a severe liquidity event triggers a 40% equity drawdown, their new 80-20 portfolio will suffer absolute losses far exceeding their modeled risk tolerance, potentially breaking their psychological capacity to stay invested.
And systematic rebalancing is the mechanical solution to portfolio drift, but its utility extends far beyond mere risk management.
What else does it do?
If we analyze the mechanics, rebalancing is the only behavioral framework that forces a human being to execute the fundamental law of compounding. Buy low, sell high.
I want to focus intensely on the mechanics of that, because it functions like a localized version of Shannon's demon.
Oh, the information theory concept.
Yeah, the concept that you can generate positive returns from volatile assets simply by continuously rebalancing them to a fixed ratio.
That's exactly the right parallel. When the annual rebalancing date arrives, the investor evaluates the drifted 80-20 portfolio against the target 60-40 mandate. To restore the balance, they are mathematically required to sell the 20% excess in the equity allocation.
So they're forcibly trimming the asset that has experienced the highest recent appreciation.
Right. They are literally selling at the high, converting paper gains into locked liquidity.
And then what?
The mandate then requires them to deploy that capital into the bond allocation to bring it from 20% back up to 40%. They are actively purchasing the asset class that has recently underperformed and is theoretically trading at a relative discount.
You are systematically extracting excess profits from your winners and using those profits to buy your laggards on sale. It is mathematically elegant.
It's beautiful on paper.
Yet 70% of investors fail to execute it. Why? Because the behavioral finance realities of rebalancing are agonizing. It violates every evolutionary instinct we possess regarding momentum and loss aversion.
The psychology is incredibly hostile to the math.
Let's visualize the exact moment of friction. You log into your brokerage account. Your tech satellite has gone parabolic. It's up 40% for the year.
You feel like a genius.
You do. The financial media is validating your brilliance, your social circle is euphoric about the sector, and the chart is a vertical green line. Meanwhile, your small cap value allocation or your emerging market core has ground sideways through a brutal macro environment.
Just dead weight.
Rebalancing demands that you actively intervene. Hit the sell button on the exact asset that is flooding your brain with dopamine and shovel that capital into the precise asset that has caused you nothing but tracking error regret for 12 months. The amygdala screams at the investor, do not cut your flowers to water your weeds. Let the winners ride.
That emotional resistance is entirely valid, which is precisely why the rebalancing mechanism cannot rely on human willpower or discretionary judgment. If you wait until you feel like the market has peaked to rebalance, you will be paralyzed by momentum bias.
You'll never do it.
The execution must be rigidly systematized, stripping the emotion out of the transaction entirely.
How do we do that?
The primary method is temporal. You select an arbitrary recurring date, the first trading day of January, your birthday, tax day.
Okay.
You set a recurring institutional mandate for yourself. On that specific date, you do not consult the macro environment, you do not read the financial press, you log into the infrastructure, calculate the drift variances, and mechanically execute the trades required to restore the target baseline. You act as an unfeeling algorithm.
Alternatively, investors can outsource the behavioral friction entirely. Right?
Absolutely.
Utilizing a target date retirement structure, a digital robo-advisor, or a fiduciary human manager shifts the execution burden. The rebalancing occurs organically within the fund structure or via the advisor's algorithmic mandate, harvesting the volatility premium without the investor ever having to endure the psychological pain of manually selling their strongest performers.
The critical imperative is not how the rebalancing is executed, but ensuring that a rigid, inescapable mechanism exists.
We have deconstructed a massive amount of structural finance today. We've exposed the 35% illusion within the S&P 500, adopted the core satellite framework to quarantine our biases, mapped the necessity of the global physical layer,
Navigated the frictional drag of currency hedging.
explored the duration of factor assets, and built the behavioral defense of systematic rebalancing.
Synthesizing all of these dimensions is a complex undertaking, but the underlying philosophy is profoundly empowering for the retail investor.
It really is a reclamation of control. Discovering that your foundational assets are highly concentrated in the tech sector should not be a moment of panic. It simply means you have been the beneficiary of a historic, multi-year, multiple expansion.
You've won the game for the last few years.
The market has handed you substantial paper wealth. The objective now is not to panic sell, but to methodically secure the perimeter. It is time to harvest the excessive concentration, restructure the architecture, and fortify the portfolio against the inevitable rotation of the economic cycle.
We must transition from a strategy of maximum upside capture to a strategy of structural survivability.
To begin that transition, we always look for the most immediate, actionable point of leverage. Today, the directive is simple. Bypass the marketing names of your index funds. Access the X-ray or portfolio analysis tool within your brokerage platform and look exclusively at the underlying sector weightings.
Just look at the raw numbers.
Identify the exact percentage of your aggregate capital that is currently exposed to U.S. technology and communication services. If that metric exceeds 30%, you are no longer passively tracking the global economy. You are actively expressing a massive, concentrated thematic bet.
A bet that could go wrong.
And it is a vulnerability that systematic, five-dimensional diversification can mechanically resolve.
As you run that analysis and confront those percentages, I want to leave you with a final analytical lens to apply to your entire financial architecture as we navigate the complexities of 2026.
What's a thought?
We expend tremendous cognitive energy agonizing over geopolitical tail risks, macroeconomic rate cycles, and the fear of selecting the wrong individual asset. But given the staggering concentration data we've unpacked today, could the single greatest threat to your generational wealth right now simply be the false, unexamined comfort of a familiar index label?
That is the ultimate structural question. A label cannot protect capital. Only mathematics can. Take a hard look at the math under your hood. Thank you for joining us on this deep dive into the source material. Build the global architecture, systematize your discipline, and we will see you next time.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.